currency manipulation is a topic that often appears in discussions about international trade, geopolitics, and global economics. When we talk about currency manipulation, we mean a country's deliberate attempts to influence its currency's exchange rate against other major currencies. Such manipulation can make a country's exports cheaper, boost its trade surplus, and give that country's industries a competitive edge in global markets. One of the countries that is frequently brought up in these decades is no other than China. Over the past several decades, the Chinese economy has grown at a remarkable pace, and China has become the world's largest exporter. Here's a graph to show you just how fast and massive China's total exports of goods and services has become. Data that we collected from the World Bank. As you can see, China's exports, as of the latest data available, sits at over $3.51 trillion, which is more than 10% of the world's total exports for that year. Here's a comparative graph of China and the world's total, which, as you can see, just shows how massive China's exports have become. The result of these have then led some analysts and policymakers to argue that one of the ways China continues to drive this economic success is that they kept their currency, known as the renminbi, RMB, or yuan, at an artificially low level. But is that actually the case? And if so, why would China do that? Well, before we answer the reasons behind China's potential currency manipulation, it is first important to understand just what is currency manipulation. Currency manipulation, in broad terms, occurs when a government or central bank actively influences the value of its currency in foreign exchange markets, with the goal of creating an advantage in international trade. In most free market scenarios, exchange rates fluctuate according to supply and demand. However, if a country's central bank buys or sells large amounts of its own currency or foreign currencies to push the exchange rate in a particular direction, this could be considered manipulation. Why do governments do this? If a currency is kept artificially weak, it becomes cheaper for other countries to buy that country's goods and services. That can help boost exports, which can fuel economic growth and job creation in export-oriented industries. Conversely, it makes imports more expensive. This can protect domestic industries from foreign competition, at least in the short term. Let's put this into perspective. Let's take the example of a Chinese good, such as a smartphone. A smartphone that would cost 1,000 yuan. Now, imagine that 1 USD equals 7 yuan. This means that the same smartphone would cost approximately $143 in the international market. However, if China were to manipulate its currency and weaken the yuan, say, to 8 yuan per USD, that same smartphone would now cost only $125 internationally. This drop in price makes Chinese goods more attractive to foreign buyers, increasing exports and boosting the domestic economy. Meanwhile, the higher exchange rate also makes imports into China more expensive, encouraging consumers and businesses to rely more on domestically produced goods, thereby supporting local industries. Now, the Chinese currency, renminbi or yuan, which people use interchangeably, has, historically, seen a tight control by China. Up until around 2005, the yuan was pegged directly to the US dollar, meaning it was kept at a set rate by China's central bank, the People's Bank of China. This tight peg helped Chinese exporters by making the yuan cheaper than it might otherwise be in a free market. Here's the official exchange rate, data that was published in the World Bank on China's currency to the US dollar. As you can see, from 1995 to 2005, China has traded at 8 yuan to the dollar. It was only after 2005 that saw the shift to a more flexible exchange rate policy. The yuan was allowed to fluctuate within a narrow band against a basket of currencies, primarily the US dollar, euro, Japanese yen, and others. Since then, the Chinese government has gradually allowed more market influence, but the central bank still intervenes when it deems necessary to maintain stability. So, did China's exports really see an advantage from 1995 to 2005? Well, let's calculate it. In 1995, the total exports of China stood at $131 billion, and by 2005, it grew to $773 billion. That's an annual growth of about 17.3%, which is very impressive. But as we mentioned earlier, from 2005, they allowed the currency to become more flexible. So, what's the growth rate from 2005 to 2015? Well, in 2015, the total exports of China stood at $2.36 trillion, with the previous data of $773 billion in 2005. The annual growth of exports of China over this period was about 11.7% per year. Still an impressive figure, but notably slower than the 17.3% annual growth experienced from 1995 to 2005. While it is slower, the causes should not be limited to the currency peg alone. There are various reasons behind a country's exports to grow. Now, since 2005, China has enabled a flexible exchange rate policy. But in 2019, the United States government, which was under President Donald Trump at that time, along with some economists, has repeatedly accused China of engaging in currency manipulation. In 2019, the US Treasury officially labeled China a currency manipulator, though it later reversed this decision. The key argument was that China sometimes allows its currency to weaken or strengthen in ways that seem strategically timed to boost exports or offset trade tariffs imposed by the United States. But, as we mentioned earlier, it was later reversed. Why? Well, let's first understand the exact criteria that led the US Treasury to determine China as a currency manipulator. The US Treasury has three main criteria to determine whether a country is a currency manipulator. The first is that there is a significant bilateral trade surplus with the United States, usually more than $20 billion. Here's a graph with data that we collected from the US Census Bureau on the trade in goods and services from China to the United States. As you can see, the bilateral trade surplus between the two nations is massive. In 2023, it's not just more than $20 billion. It's more than $270 billion. And this significant bilateral trade surplus has been seen since the start of the 21st century. Hence, you can see how China already lands in the first criteria of the US Treasury. The second here is that a country must have a material current account surplus that is at least 2% of GDP. What this basically means is that the country exports significantly more goods, services, and capital than it imports, resulting in a net inflow of money. A current account surplus is often seen as an indicator of economic strength, but when it exceeds 2% of GDP persistently, it can raise concerns about imbalances in global trade. Here's a graph with data that we collected from the World Bank on the current account balance as a percentage of GDP of China. As you can see, even though China has a big surplus in trade with the United States, their current account balance doesn't really reach more than 2%, at least in the latest years. From 2016 to 2020, their current account balance was much less than that figure. In 2019, the year the US Treasury listed China as a currency manipulator, was the same year they had a current account balance to GDP of just 0.7%. In 2018, the current account balance was even at just 0.2%, which was nearly at a negative. But it is important to know that it was in 2018 that saw the start of the trade war between China and the US, which may have caused a decrease in the current account balance of China from 2017 to 2018. Furthermore, China's current account balance to GDP has also increased to more than 2% in 2021, as well as 2022. Nevertheless, in 2019, the year the US Treasury listed them as a currency manipulator was much less than the needed criteria. So, China shouldn't have been listed as a currency manipulator as it failed to reach that point. Thirdly, the last main point is that a currency manipulating country persistently engages in one-sided intervention in foreign exchange markets, usually indicated by net purchases of foreign currency, equating to at least 2% of GDP over a 12-month period. Of the three main criteria, China often meets the first criterion, large trade surplus with the US, but doesn't always meet the others, especially not on a consistent basis. The US Treasury designated China a currency manipulator in August 2019, but removed the label in January 2020, which should be because China did not really meet the standard for manipulation. But, according to various reports, it's because China had agreed to refrain from devaluing their currency to make their goods cheaper for foreign buyers. Hence, China's manipulation, according to the US Treasury, might be short-lived. But while China has been accused of devaluing their currency, there's actually a counter-argument case that made the yuan stronger, rather than weaker. Some economists and news articles out there have pointed out that sometimes China has actually been propping up the yuan rather than weakening it. For instance, from 2015 to 2016, China experienced significant capital outflows, people moving money out of China. Here's a graph on China's net financial account on the balance of payment, data that we collected from the World Bank. As you can see, from 2016 to 2019, the net financial account was negative, with the year 2018 seeing the biggest outflow of over $153.8 billion. Here's another graph on China's net errors and omissions on the balance of payment, from the same source. What this data is about is tracking unexplained discrepancies in the balance of payments. These net errors and omissions often indicate hidden capital flows, such as money leaving or entering the country that isn't captured through official channels. For China, this data is significant because it can highlight unrecorded capital outflows, especially during periods of economic uncertainty or regulatory tightening. For example, from 2015 to 2017, China experienced large negative figures in this category, suggesting substantial untracked capital leaving the country. Now, when capital leaves the country, especially at these amounts, the yuan can fall, and sometimes it can fall too quickly. To prevent that from happening, the PBOC spent large amounts of its foreign exchange reserves to buy yuan in the open market. Here's a graph on China's total reserves, data from the World Bank. As you can see, China's total reserves dropped from 2014 to 2016, where in 2014 the total reserves stood at $3.9 trillion. But by 2016, it fell to $3.1 trillion. One of the reasons behind this is the central bank, PBOC, spending a lot of money to support the yuan's value. This kind of intervention is then the exact opposite of China's currency manipulation of making the yuan undervalued to boost exports. So, is China manipulating their currency? Well, it depends on who we are asking and what people's definition of manipulation is. From a purely free market viewpoint, the fact that China maintains capital controls, sets a daily reference rate, and actively intervenes in currency markets can be viewed as forms of manipulation. But it's also true that many countries manage their exchange rates to some degree. China's size and its large trade surplus make its actions much more prominent on the global stage, thus garnering more scrutiny. If you prefer a more neutral term, you could say China's currency is heavily managed rather than manipulated. But anyway, do let us know what you think. Thanks for watching.